Hello and welcome to a brand new episode of Smart Money. Now, in the recent past, we've seen a significant uptick in investor interest in gold exchange-traded funds, or ETFs as we call it. In the month of August alone, gold ETFs have witnessed the highest inflows in the last 16 months. The question we're asking today, is it time now to invest in the yellow metal? As we know, gold ETFs function as electronic representations of physical gold stored electronically in a demat account. Now, these ETFs are listed on the stock exchanges, providing real-time price updates. The biggest benefits of gold ETFs are liquidity, there's no exit load, diversification in your portfolio, and easy trading. Today, Ghazal Jain, Fund Manager, Alternative Investment at Quantum AMC, joins us now to talk more about that. Ghazal, thanks a lot for joining us. I want to start with, just to set the tone, right, of the interview. July and August were big months in terms of gold ETF investments. What is the outlook and what is the reason for which this investments are happening?
Inflows into the gold ETF category over the last year or so have been subdued, and that was mostly because the US Federal Reserve had embarked on a monetary policy tightening, which had really reduced interest in gold for investors. But over the last few months, like you mentioned, we have seen some steady inflows, and that is despite domestic equity markets being so robust. I think it's very prudent of investors, because while the domestic growth story looks promising and the domestic macros are supportive of growth, domestic equity markets are not immune to external economic shocks. I mean, there's so much uncertainty related to growth and inflation globally. So I think investors coming into gold at this stage is very prudent. And looking ahead, I would say that now we are approaching the end to the monetary policy tightening by the Fed, and that has kind of really improved the prospects for gold going forward, and hence we think this momentum in gold ETF inflows that we've been seeing, that should continue for the rest of the year.
Okay, so let's talk about a couple of things, right? Whether it's the US Treasury yields and the US dollar, both of which are the nemesis of gold, right? Now, these are on the rise. So we've seen the dollar index as well stay well above that 105 mark. How is gold reacting to this? And as an investor, how do you, look at these parameters to assess which way gold prices are headed?
So usually US Treasury yields, they see an uptick when there is either an uptick in inflation expectations in the US, or there is an interest rate hike by the Federal Reserve. Of late, that is not what is really driving US Treasury yields, because that is usually bearish for gold. But in the recent past, this uptick in US Treasury yields is a lot to do with the fiscal situation in the US. With interest rates at such elevated levels, and US government elections coming up next year, and the spending programs of the Biden administration, there is a sense in the markets that the supply of US government debt is going to going forward exceed the demand. And if we talk about the demand, what's really impacting it? The US Federal Reserve is one of the largest buyers of US government debt. And as we know, they have been unwinding their balance sheet for the last year and a half. So that sort of demand has, moved out of the market. Also, external buyers like China and Saudi Arabia, I think in their agenda towards de-dollarization or reducing their reliance on the dollar, they have also been reducing their US Treasury holdings. So we have this very unique situation where US government debt supply, is expected to be higher than the demand, and that has been putting like a downward pressure on US Treasury bond prices and an upward pressure on US yields, and that is not exactly bearish for gold. In fact, it is supportive of gold investment, because it shows that markets are concerned about the unsustainability of US debt levels, and that should actually divert flows into havens like gold.
So I have a counter argument to that. Sure. The expectations from the Fed Reserve's September 20th meet is that there would be perhaps maybe a pause, and there could, or maybe a small rate hike, but there could also be an indication of the end of the tightening cycle, right? If that comes through, then from there on, risky assets like equities may sort of surge. In that context, don't you think safe haven like gold may move to the back burner?
Sure. So, in the recent months, there has been this Fed pivot narrative that has come into the markets. But if you look at the data, US economy has been showing resilience. US labor markets have been showing resilience. And on the other hand, core inflation numbers in the US have been looking sticky. So we've been seeing that the Fed has actually been pushing back hard against that narrative. They have been giving out really hawkish comments. And so the markets are expecting a status quo or a pause from the Fed in September. But if you see, they have pushed back interest rate cuts to about June of next year. So whether the Fed can increase more interest rates higher than these levels, time will tell whether the US economy can digest more of that. But as far as the data is shaping up, we've seen US inflation in July and August kind of moderate, and we also expect the Fed to do nothing in
to
September.
Pause this time.
Yes, and that should be good for gold. For risk assets, the worry is, of course, the Fed pausing is a positive, but the Fed pausing could also, reflect that they are seeing some weakness in, on the growth fronts. Yeah, which is kind of leading to that, and that would again be positive for gold.
But in any case, I guess, gold is always a great diversification strategy, right? I mean, it's always good to have some amount of gold in your portfolio, and as we know, whether it's sovereign gold bonds, gold ETFs, it's a great way to approach it. Another angle that we're looking at is rising energy prices, right? Does it complicate the global inflation situation? And if yes, because crude as we speak is at $94 a barrel. If that happens, then what is the prognosis on gold?
So, rising crude prices are definitely a cause for concern, because if you see the moderation in US inflation that we've seen over the last few months has also a lot to do with supply pressures easing, that is commodity prices coming down, because core inflation numbers, which do not include fuel prices, have been sticky. And also what has been helping US inflation is, the favorable base effects. US inflation peaked in June, July of last year, and that, has helped year-on-year inflation numbers look softer over the last few months. Whether or not, that will sustain is a question mark, because we'll see these base effects moving out. And like you pointed out, yes, rising energy prices will definitely complicate that situation and, make this inflation situation a little trickier for the Fed. And I think that is why there is this expectation in the market that we can see above average inflation, for the foreseeable future, which is, bullish for gold.
Okay, just for someone who perhaps has never had any exposure to gold and is building their corpus, right? Let's try and understand before we head into a break. There are gold ETFs and there are sovereign gold bonds. There's of course physical gold as well, but we are not proponents of that because of just the clunky nature of the investment, safety, security, all of that. So between gold ETFs and sovereign gold bonds, and we've had this discussion in the past, where do your preferences lie? I mean, is sovereign gold bonds a better option? And, what is the key difference?
So both, I think, sovereign gold bonds and ETFs definitely score above physical gold, like you said, and both are ideal for long-term investment. But there are a few nuances. Sovereign gold bonds, pay an annual interest and are tax efficient, which has been really, getting them a lot of attention. But on the other hand, gold ETFs also have their set of benefits. The number one being that, gold ETFs are physically backed by 24-karat physical gold, and for some, that is kind of important, and that's justified
it's
because
like a safety net also.
Right, because gold has always been seen as an asset that is no one's liability,
Yes.
And by shifting that liability to the government, you're kind of changing the nature of gold. So we are seeing, a lot of investors still prefer ETFs over sovereign gold bonds because of that physical backing. And another thing I think that where, gold ETFs score above sovereign gold bonds is from the portfolio perspective. So because sovereign gold bonds come with a lock-in period and those tax benefits only kick in if you hold them till maturity.
There's an 8-year lock-in, right?
Yes, there's an 8-year lock-in, and those tax benefits will only kick in if you hold them till the end, which means the secondary market liquidity is kind of limited. So if, for example, gold prices move up and you want to rebalance your portfolio by trimming your gold holdings, you're not going to be able to do that. If you do that, if you sell your sovereign gold bonds on the secondary market, you might be just, selling them at a discount, which is price inefficient and could eat into your returns, partly or even entirely offsetting that interest payout that the bond was giving.
Absolutely.
And on the other hand, gold ETFs, exchange traded, like you said, extremely liquid, trading very close to market prices. So
there's no exit load as well.
No exit load at all. Yeah. So you can be assured that from a portfolio perspective, the liquidity that it gets, the price efficiency that it gets, gold ETFs, can be a very
better option.
A
So
better option.
Basically, it just trades like how you would trade a mutual fund, right?
Right.
And I mean, for someone who perhaps has no exposure, how do you buy it in the number of units? I mean, if you can just explain to us.
Sure. So gold ETF units, they trade on the exchange like shares.
Okay.
So you can buy even 1 unit of the gold ETF, and 1 unit is approximately equal to 0.01 grams of gold, which in today's prices is just 60 rupees. So for just 60 rupees, you can start building your exposure to gold. How you go about it is you need a demat account, just like you buy and sell shares through a broker. You can buy and sell units of gold ETF through your demat account. And if you are not, you're not interested in having a demat account, there's always the mutual fund route, because we have these gold mutual funds that invest in the gold ETF on your behalf. So you can, in a more simple and convenient way, kind of opt for that.
And a hassle-free way. Somebody else is doing the investing for you through the mutual fund.
Yes, there's no timing of gold prices or markets there, and as well as it gives you the option of, systematic investments because of the SIP route, which is a good way to, actually approach gold, because it's a strategic asset. You want to stagger and buy, the asset class instead of just running behind it when prices are, running up.
Absolutely, absolutely. That's very helpful, actually. And it's always good to revise these these classics, right? I mean, everyone wants to have a little bit of exposure in some of these asset classes, but a lot of our viewers, a lot of young investors don't know how to approach it. So thank you for that. Let's do one thing. Let's take a short commercial break, but don't go anywhere. When we come back, we'll continue to talk about this rush into gold ETFs and how you can have it as a part of your portfolio and what the best approach is. Stay tuned. Welcome back to Smart Money. One asset class that has got a lot of investments lately is gold ETFs. And Ghazal Jain, fund manager, alternative investment at Quantum AMC, is here to tell us how you should invest into gold ETFs and how you should make it a part of your core portfolio as well. Ghazal, before the break, we were talking about how gold ETFs and gold sovereign gold bonds, there are two ways to invest, right, into gold, which is not physical gold. I think a better route, perhaps because of better liquidity and ease of investing, is through the gold ETF route. But let's understand demand trends as well. In the second half of 2023, what can we expect in terms of core gold demand trends, and do you see prices moving higher?
Sure. So the first half of 2023, we saw physical demand was a little subdued because prices were at record highs, and inflation was really taking a toll on discretionary spending. We saw that was kind of subdued. But looking ahead to the second half of 2023, of course, we're starting on an optimistic note. This is the festival and wedding season starting. There are still concerns about, the underwhelming monsoons, impacting rural incomes, and hence the demand for physical gold in the second half as well. But there are also, this could be offset by some government spending in the run-up to the general elections next year, which could boost rural incomes. So I would say the outlook for physical demand for the second half is kind of mixed. But if you look at some estimates, there are talks that the entire year physical gold buying this year would be lower by about 10% from last year, closer to 700 tons for the whole year, compared to close to 800 tons that we saw last year.
Okay, so if demand is going to go up, there's a big wedding season coming up. Do you see gold prices as well moving up? I mean, currently, where are we at in terms of gold prices in the MCX market, and what kind of, what's the prognosis now amongst the people that you speak to?
Sure. So, we are bullish, or we think the fundamentals are looking constructive for gold in the medium term, and that is primarily because the monetary tightening that we've seen in the developed world, be it the US or Euro area, is going to come to an end sooner rather than later, and that really fundamentally improves the prospects for gold. That's for sure. But in the interim, like in the very near term, we can expect some consolidation in prices. That's because 1 or 2 tactical rate hikes from the Federal Reserve cannot be ruled out, and that would kind of limit the upside in gold prices. So I think now the next few months are a good time or an opportune time for investors to build their allocation, because the downside from here doesn't look much. Like we mentioned,
limited.
Yes, because the higher than average inflation, lower than average growth, the geopolitical tensions, central bank buying, all of this are actually supporting interest in gold. So the downside should not be limited. So a buy on dip strategy should be good.
Should work.
And
you spoke briefly about central bank buying. Are we seeing a lot of central bank gold buying? Just want to understand what are the numbers looking like now compared to what it was, say, a year ago?
Yeah, so I think last year was a record year for central bank purchases, upwards of 1,000 tons, and an average year for central bank gold buying looks around 500 to 600 tons. So last year was amazing, but that was mostly because the Russia-Ukraine war kind of stirred up risk aversion in the markets, and there was this sense of countries feeling vulnerable to the US weaponizing its currency. So they wanted to diversify away from the US dollar. But this year as well, of course, we don't expect those kind of numbers to come back, like I said, but the first half of the year, up to June, we've seen central banks buy close to 390 tons of gold, which is the highest first half on record. July also, they've bought 55 tons. So looks like this is going to be a second consecutive year of strong central bank buying, and that will be, a soft support for gold prices going forward.
Okay, so since we do believe that there is, of course, this narrative that gold prices are going to move up higher, gold ETFs are a great way to, sort of allocate money in your portfolio, and now is a good time to buy gold. Are gold ETFs, gold mutual funds, a good way to take exposure? We've, of course, discussed that. You folks at Quantum have a gold fund of fund as well. So tell us, somebody wants to start, is it the best way to take, exposure? And if you have, say, 100 rupees, right? I mean, of course, if you're somebody who's young and building your corpus, I assume a large chunk of that will be in equity. But if you had to divide it amongst asset classes, equity, debt, gold, what would the ratio be?
Sure. So, gold is such a unique asset class because it has both pro-cyclical and counter-cyclical drivers. So when economic times are not good, we see investment demand for gold increase. And when economic times are good, we see consumption demand for gold increase. So it's so unique, it's so multifaceted that, we always tell our investors to look at it from a strategic point of view. Another thing is that, investors tend to look at gold in isolation, as in they will try to chase returns and time their entries and exits. We say that you should actually look at it from a portfolio perspective, because return generation is an added advantage, but gold's true utility is its risk mitigation. Because of its negative correlation to risk assets like equities, it tends to limit your downside. So from a multi-asset or an asset allocation perspective, 15 to 20% allocation to gold through efficient vehicles like gold ETFs and gold mutual funds is a good way to approach this, because if you see around those levels, gold can reduce your risk without really impacting your returns. Like you said, equity has to be the major chunk of the portfolio, but a 15 to 20% allocation to gold should be a good way to approach it.
Okay, so all of you young folks who are perhaps beginning your career or beginning your wealth creation journey, a 15 to 20% allocation to gold is always a prudent strategy. What is the role of gold in multi-asset portfolios?
So those who do not want to say, open a demat account and invest in gold ETFs directly, there are two ways to go about it in the mutual fund route. There are gold fund of funds, like I mentioned, which invest in the gold ETF on your behalf, which are more convenient. You can just, open a folio like you open in any mutual fund and start investing. And and what's better is that you can do it in a staggered way. The other option is multi-asset funds. They also give an exposure to equities, fixed income, and gold. And their gold allocation is through gold ETFs. So if you're looking for an asset allocation solution, you can look at multi-asset funds, which will take that exposure for you through efficient vehicles like gold ETFs.
Okay, and in gold, in sovereign gold bonds, I just wanted to ask you, because we get a lot of queries on this, right? This 8-year lock-in, what is the, post 8 years, what is the kind of, say, okay, let's compare taxation for the entire thing, right? Gold ETFs versus sovereign gold bonds. How is the taxation part handled? Say, what is better between ETFs and SGBs?
Sure. So on the taxation front, SGBs score above gold ETFs currently, and this has been actually a recent phenomena because recently when the taxation rules for debt mutual funds were changed, gold ETFs were a collateral damage to that, and they also lost the indexation benefit for long-term capital gains in the process. And on the other hand, sovereign gold bonds, if held till maturity, the capital gains are tax-free. So from a taxation perspective, SGBs will score over gold ETFs, but I think I would like to tell investors that taxation should not be the sole criteria for choosing an investment avenue. We Indians tend to do that, but price efficiency can be a function of not only taxation, but also, liquidity, because liquidity comes with its costs as well. So I think that is something, that ETFs can provide them, and they should take a, sensible, all-rounded and...
Absolutely. And I think also as you grow older, perhaps not for the younger generation, as you grow older, when you're 35, 40, it's always better to have a lot of your money in liquid assets, right? So if gold ETFs is something that you can withdraw immediately, there is no exit load, rather than, with SGBs, which has such a long duration holding period, you prefer
also,
gold ETFs.
Sonia, imagine if there's an 8-year lock-in, okay, you get into gold SGBs right now. Imagine 8 years later, the prices are down. So you did not have an exit option before to, book your profits, say at year 5 or year 4 or year 6. So 8 years down the line, you never know, prices could be down, and you would be forced to be, there would be no capital gains for them to be taxed.
to
so
be
this
taxed,
is something, because we're so focused on, the taxation that we kind of miss out on these nuances. Which,
and I think that's the same thing with equities as well, right? I mean, equities are taxed, but at the end of the day, the amount of returns that you make far outweigh the kind of taxation that you'd have to pay in terms of long-term capital gains.
Yes.
Okay, Ghazal, it was great speaking with you. Thank you so much for joining us. I didn't realize how half an hour passed. Learned so much on the gold ETF space and, of course, what's happening. Thanks for being with us on the channel.
Thank you, Sonia.
Okay, well, with that, it's a wrap on this edition of Smart Money. Keep writing to us about the topics you'd want to see, about the discussions you'd want us to have, and we'll be glad to take it up on our show. Thanks a lot for watching. Have a great weekend.